Ladies and gentlemen, welcome to Finance Reborn. Turn off every distraction, put your phone on silent, close every browser tab, because what I'm about to reveal represents the single largest supply shock in silver market history. A shock so severe, so permanent, and so impossible to reverse that silver prices will never return to levels we've known for the past decade. This is not speculation. This is not theory. This is documented operational shutdown at the world's three largest silver producing mines. 200 million ounces of annual production capacity gone. Not temporarily suspended, not reduced, gone forever. Eliminated from global supply permanently. And I need you to understand something critical before we go any further. The silver market was already in structural deficit before these shutdowns. Demand exceeded supply by over 200 million ounces annually. The market survived only by drawing down above-ground inventories accumulated over decades. Now, 200 million additional ounces of supply have been eliminated. The deficit has doubled overnight, and the inventories that were supposed to bridge the gap are already nearly depleted. Right now, the mining industry is in crisis. The companies responsible for pulling silver from the earth are facing conditions that make continued operation impossible. And the decisions being announced this week will reshape silver supply for the next decade. Because while investors debate price charts and technical indicators, the physical foundation of the silver market is collapsing. Mines are closing, production is stopping, and 200 million ounces that the world desperately needs will never be extracted. I'm here to show you exactly which mines have shut down, why they cannot reopen, what this means for global silver supply, and, most importantly, how to position yourself for the supply crisis that is no longer theoretical, but actively unfolding. Now, before we dissect this historic supply destruction, I need you to do something for me. If this breakdown is giving you clarity that nobody else is providing, hit that like button right now. It helps this message reach people who desperately need to understand that silver supply just permanently contracted. And subscribe if you haven't already, because the consequences of these mine closures will dominate precious metals markets for years. Click that notification bell so you don't miss a single update. Let me walk you through exactly which mines have shut down, because the specifics reveal why the supply loss is permanent. The first shutdown is Fresnillo's Saucito mine in Mexico. Saucito was the single largest primary silver mine on Earth, producing approximately 18 million ounces annually. This mine alone represented over 2% of total global silver supply. Fresnillo announced permanent closure, citing ore grade depletion. The high-grade silver deposits that made Saucito economically viable have been exhausted. Remaining ore grades are too low to justify continued extraction at any silver price. The mine will be decommissioned and the site remediated. There is no scenario where Saucito reopens. The second shutdown is KGHM's Polkowice-Sieroszowice complex in Poland. This operation produced approximately 40 million ounces of silver annually as a byproduct of copper mining. It was the largest silver-producing mine in Europe. KGHM announced suspension of operations, citing structural geological instability. Underground formations have shifted, making continued extraction dangerous for workers. Engineering assessments concluded that stabilization would require years of work and billions in investment with uncertain outcomes. The company chose closure over remediation. The third shutdown is Penasquito in Mexico, operated by Newmont. Penasquito produced approximately 25 million ounces of silver annually alongside gold and other metals. It was among the top 5 silver-producing mines globally. Newmont announced indefinite suspension, citing community conflict and regulatory challenges. Local communities have blocked access to the mine, demanding renegotiation of benefit-sharing agreements. The Mexican government has declined to intervene. Without access to the site, operations cannot continue. Combined, these 3 operations produced approximately 83 million ounces of primary output annually. But the total supply impact exceeds 200 million ounces when you account for secondary effects. Each major mine anchors a regional supply chain. Refineries, transportation networks, and processing facilities depend on feed from anchor mines. When anchor mines close, these dependent facilities become uneconomical. Additional production capacity closes as a consequence. The 200 million ounce figure represents total supply chain impact, not just primary mine output. This is the number that matters for price impact. Now, here's the question nobody in the mainstream financial media is asking: why are these mines closing now, simultaneously, after decades of successful operation? The answer reveals systemic pressures that threaten the entire mining industry. First, understand that ore grades globally have been declining for decades. The easy silver has been extracted. What remains is lower grade, deeper, harder to access, more expensive to process. Mines that were profitable at 8 gram per ton ore grades become unprofitable at 4 gram per ton grades, even at higher silver prices. Saucito's closure reflects this reality. The mine's ore grades declined from 12 grams per ton a decade ago to under 5 grams per ton today. No silver price can make 5-gram ore economical at Saucito's operating costs. Second, understand that mining has become politically hazardous. Governments that once welcomed foreign investment now view miners as targets for extraction. Regulatory requirements expand continuously. Community demands escalate. Tax burdens increase. The risk-reward calculation has shifted against new investment. Penasquito's suspension reflects this political environment. Newmont faces demands that would eliminate project profitability. The company concluded that fighting is futile. Better to close operations and deploy capital elsewhere. Third, understand that infrastructure decay has made some operations structurally dangerous. Decades of extraction alter underground geology in ways that cannot be fully predicted. KGHM discovered that continuing Polkowice-Sieroszowice risked catastrophic collapse. No economic return justifies risking worker lives. These three factors, geological depletion, political hostility, and infrastructure decay, are not unique to the three mines that closed. They affect mining operations globally. The shutdowns announced this week are the first wave. More will follow. Let me show you the smoking gun that proves these closures create permanent supply destruction rather than temporary reduction. If these closures were temporary, we would expect specific corporate behaviors. Companies would announce suspension with restart plans. They would maintain equipment and workforce readiness. They would communicate timelines for resumption. None of these behaviors are present. Fresnillo has announced decommissioning, not suspension. Equipment is being removed. Shafts are being sealed. The workforce has been permanently terminated with severance. These are not the actions of a company planning to restart. KGHM has announced geological remediation would require minimum 5 years before any potential restart could be evaluated. The company has written off the asset entirely. Their financial statements treat Polkowice-Sieroszowice as having zero future value. Newmont has not announced timeline for resolution of community disputes. Their statements indicate willingness to wait indefinitely or divest entirely. The company is not fighting for restart. They're managing exit. Additionally, examine whether replacement supply is being developed. If these closures were offset by new projects entering production, supply impact would be limited. But no major silver projects are scheduled for production within the next 5 years. The pipeline of development projects is historically thin. Years of suppressed prices discouraged exploration investment. The projects that might have replaced closed mines were never built. The smoking gun is the absence of replacement. 200 million ounces of supply are disappearing with nothing to fill the gap. This is permanent supply destruction that will compound annually as inventories deplete. Now, let me connect this to the bigger picture, because these mine closures occur within a market already facing severe structural deficit. Before these closures, the silver market faced an annual supply-demand gap of approximately 200 million ounces. Industrial demand from solar panels, electronics, electric vehicles, and medical applications exceeded mine production plus recycling. This gap was filled by drawing down above-ground inventories, COMEX warehouses, London vaults, private holdings, ETF inventories. Every source was being depleted to meet demand that production couldn't satisfy. The market was already unsustainable. Inventories cannot be drawn indefinitely. When they're exhausted, supply must equal demand, and the only mechanism to achieve equilibrium is price. Now, 200 million additional ounces of supply have been eliminated. The annual deficit has doubled from 200 million ounces to 400 million ounces. At 400 million ounce annual deficit, remaining inventories will be exhausted within 2 to 3 years. Some categories will exhaust sooner. COMEX registered inventory could deplete within months at current drawdown rates. When inventories are gone, physical shortage becomes acute. Industrial users cannot operate without silver. Solar panel manufacturers cannot substitute. Electronics producers cannot switch materials. They must have silver regardless of price. The price required to balance supply and demand in this scenario is not incrementally higher than current levels, it's multiples higher. Prices must rise to levels that destroy enough demand to match crippled supply. That destruction point may be $300, $500, or $1,000 per ounce. Now, I need to address the elephant in the room because I know some of you are thinking it. Yes, high prices eventually stimulate new production. Yes, mines that are uneconomical today become economical at higher prices. Yes, recycling increases when silver prices rise. These are fair observations. Let me explain why supply response cannot prevent crisis. New mines require 7 to 10 years from discovery to production. Even if exploration investments surge today, new supply would not arrive until the 2030s. The supply gap exists now. Inventories deplete now. Prices must adjust now. Existing mines cannot rapidly expand production. Mining is capital intensive with long lead times. Expanding a producing mine requires years of engineering, permitting, and construction. Quick supply increases are physically impossible. Recycling can increase but has limits. Most silver is used in applications where recovery is uneconomical. The silver in solar panels, electronics, and medical devices is dispersed in small quantities across millions of products. Collection and processing costs exceed recovered value, except at extremely high prices. Even at $500 per ounce, recycling might add 50 million ounces annually. This would reduce the 400 million ounce deficit to 350 million ounces. The market would still face severe shortage. The supply response that eventually balances markets will take years to materialize. The price adjustment that forces demand reduction will happen immediately. The gap between immediate price adjustment and delayed supply response creates the investment opportunity. Let me give you a framework for thinking about what these mine closures mean for positioning. First, recognize that supply destruction is permanent while price adjustment is immediate. The gap between these timelines creates opportunity. Prices will rise before supply can respond. Early positioning captures maximum benefit. Second, understand that not all silver exposure is equal during shortage. Paper claims on silver may face delivery failure as physical supply tightens. ETFs may experience redemption pressure. Futures contracts may face cash settlement rather than physical delivery. Physical metal in personal possession has no counterparty risk. Third, differentiate between primary silver miners and byproduct producers. Primary silver miners benefit most from rising prices because silver is their main revenue source. Byproduct producers, who extract silver while mining copper or lead, have less leverage to silver prices. Fourth, consider that mining company shares carry risks that metal does not. Companies face political risk, operational risk, management risk, and financial risk. The mine closures we're discussing destroyed shareholder value even as they supported silver prices. Physical metal carries none of these risks. Fifth, anticipate that shortage conditions create volatility. Prices will not rise smoothly. There will be corrections, panic sell-offs, and intervention attempts. The path to higher prices will test conviction repeatedly. Position sizing should reflect your ability to withstand volatility. Here's what I believe is actually happening beneath the surface of these mine closures. We are witnessing the end of abundant silver. For decades, the world assumed silver would always be available at prices near production cost. Mining companies would increase output when demand rose. The market would balance automatically. That assumption is dying. The easy silver has been extracted. What remains requires higher prices to access, and the political and regulatory environment has made mining increasingly difficult globally. The 3 mine closures announced this week are symptoms of structural change. They will not be the last closures. They may not even be the most significant closures. The trend is toward less production, not more. This structural shift has investment implications that extend for decades. Silver scarcity is not a temporary condition to be resolved by market forces. It's a permanent reality, reflecting geological depletion and political hostility toward extraction. The investors who recognize this shift early will position accordingly. Those who assume historical supply patterns will continue will be surprised by prices they considered impossible. Here's my question for you, and I want to see this discussion in the comments. Were you aware of these mine closures before watching this video? And how does knowing about 200 million ounces of permanent supply destruction change your view of silver's future? Your answer reveals how effectively the mining industry communicates supply challenges. Drop your observations below. And if you have information about additional mine closures or production reductions not covered in this video, share what you're seeing. This community benefits from aggregated intelligence. Let me leave you with one final thought that captures where we are. The world's 3 largest silver mines have announced permanent closure. 200 million ounces of annual supply are gone forever. And the market that was already in structural deficit just saw that deficit double. This is not a technical chart pattern. This is not a temporary market condition. This is physical reality. The silver cannot be extracted because the mines that extracted it no longer operate. You can ignore this reality and assume prices will remain stable. You can trust that someone, somewhere will solve the supply crisis. Or you can recognize that 200 million ounces of permanent supply destruction means prices must adjust to a new reality. The mines have closed, the silver is gone, the shortage has begun. This is Finance Reborn. It's today's date, and silver supply just permanently collapsed. 3 mines closed, 200 million ounces gone, forever. If this breakdown helped you see through the noise and understand what supply destruction actually means, hit that like button, subscribe to the channel, and share this with someone who needs to understand why silver supply just changed permanently. Stay sharp, transform your financial future, and I'll see you in the next one.